you can get lost in the weeds very quickly, but I think in the end, it all comes down to a little bit of common sense. Multinational corporations do business in many different jurisdictions. These different jurisdictions have different tax rates. So the name of the game in tax planning is to get as much profit into the low tax jurisdiction and out of the high tax jurisdiction. And since now the United States is the highest statutory rate in the world, that pretty much means getting money out of the United States. So how do you do this tax planning? Well, U.S. multinationals, the parent companies and their subsidiaries engage in lots of transactions with each other. They sell goods and services to each other, and they have to charge prices to each other. So let's say you have a U.S. parent tech company and an Irish subsidiary, and that Irish subsidiary manufactures, let's say, computer keyboards, and you have to transfer those back to the United States for sale. Well, if you can get the price of those keyboards, that transfer price from Ireland to the United States to be high, well, then there's going to be a lot of profit in Ireland, and there's going to be correspondingly less profit in the United States. And that is, you don't need fancy tax shelters or elaborate tax planning. You just need to adjust that price. And so this has been the name of the game for many, many, many years. And if it was 10 or 15 years ago, I would just stop there. But the world's gotten a little more complicated in the last decade. So we'll go to the next slide. But what's changed? Well, we all know the world has become more international, business has become more international, capital is more mobile. But the two things I would like to focus on are that so much more of value creation in the world is not bricks and mortar, it's about intellectual property, patents, technology, trademarks, what we call in the biz intangibles or intellectual property. Two things to keep in mind about intellectual property. It's highly mobile, unlike a steel factory. And also it's very hard to value. And these are two features which are just great for tax planners, because what you can do is instead of thinking about the U.S. parent where the headquarters is and where all the research is done, or the foreign subsidiaries where most of the sales are and most of the manufacturing is, those are usually countries with real tax systems. What you can do is you can take those intangible assets and transfer them to a tax haven holding company at a relatively low price, and then that tax haven holding company can charge royalties to the subsidiaries and to the parent companies where all the real activity is taking place. And so that's why companies in the pharmaceutical sector and the technology sector have such low effective tax rates. They have so much intellectual property that lends itself to this type of maneuvering. And there's another very cute development. Since Chris and I were doing transfer pricing 2 decades ago, they didn't have any of this. They have something they call risk shifting, where they write contracts, related party contracts between subsidiaries, between affiliates, and they say, oh, the low tax, the subsidiary or the holding company in the tax haven, well, it's assuming a lot of risk, so it deserves to have a lot more profit assigned there. And so the manufacturer in the manufacturing subsidiary, which is usually in a mid-tax country, or the sales subsidiary, which is usually in a high-tax country, well, they're not really doing that much, so there shouldn't be that much profit there. And so what you end up with is a situation where you have a lot of stuff going on in the U.S., you have research, you have all the execs there, all the planning's done there, and then you got the foreign subs in countries like Japan, UK, Germany, Italy, countries with real tax systems, where the manufacturing is being done, where the sales are taking place, but then you have most of the profit in a tax haven or a low tax jurisdiction where there is either no activity at all, it's just a shell corporation, or it's just a company with just a few employees. So we have two ways of policing this type of profit shift. The overwhelmingly dominant way for the last 5 decades has been something called the arm's length system. And here's where the US regulations have the arm's length standard, our 60 tax treaties have the arm's length standard, the OECD treaty has the arm's length standard. And what it says is, when you do these transfers between subsidiaries of a corporation, well, you should do that at an arm's length price. And what that means is, imagine, if you can, that these two entities were separate entities and that they were engaged in a market transaction. Well, the problem with this, and I won't dwell on it, but take my word for it, is there's a wide range of possible prices that very smart economists can come up with. And very small adjustments in those transfer prices can make very large differences in the profit allocations. And so the arm's length system, when you look through the data and you see that there's profit rates 3 or 4 times higher in Ireland than there are in Germany, and you see that there are tremendous accumulations of profits in tax havens, the arm's length system is not putting the profits where the economic activity is. Which brings us to the second way of doing things, which is the formulary method. And the formulary method is very simple to understand. You look at worldwide profits, and you say, what's a fair allocation of these profits? And what you do is you look at, see, where is the real stuff? I'm using a technical term here, stuff. Where is the real stuff happening? And if you look at this picture, well, the real stuff is happening in the United States, where the headquarters are, the research is. And the real stuff is happening in the foreign subsidiaries, where there's manufacturing and sales. But there ain't no real stuff happening in the tax haven. And so we would not be allocating a lot of profit there. The type of stuff that is actually being measured would be either sales, or assets, or property, or employees, or workforce payroll, but real, tangible economic activity would be used to allocate these types of profits.